Hi everybody, this is Sahab and Giacomo, and today I'm with Michael Ball. He runs Midday Macro on Substack. Michael, please introduce yourself and then let's get into the content.
Sure. My name, as Giacomo said, is Michael Ball. I have a Substack called Midday Macro. I also run a consultancy firm where I advise people on macro picture issues. This can be anyone from small businesses, government officials, to people who are mathematically inclined, like quant funds, and just want to understand where we are in the cycle, or what are some of the data and the issues, the narratives of the day. And as a result, it gives me a wide breadth, and I look at most G7 markets pretty closely, but it primarily focused on the US markets, the Fed, the US economy. Title of my presentation is Uncertainty. I think that encompasses what we just went through in March pretty well. Clearly, there was a bout of financial instability. This was highly profiled by Silicon Valley Bank, but worked its way into several other banks, moved across the Atlantic, and ended up being the demise of Credit Suisse, which was a slow train crash for several years now, but due to the pressures exhibited from other things, finally had to be merged with UBS. So again, the presentation is really just sort of focused on how we have actually more questions now on where the Fed policy and extrapolating to other central banks, monetary policy more generally is going due to this increased financial instability, but also due to the persistent inflation that we're seeing more so in America, but globally as well. So let me go on to the next slide here. So the current narrative is really one where we had a good start to the year. The January data, especially in America, was quite impressive. We had strong jobs numbers, we had strong consumption numbers, and as a result, or also because of the fourth quarter activity, we had strong inflationary data. We saw a pickup sort of inflationary readings, which then changed the narrative of the Fed from easing to these 25 basis point hikes to potentially raising that to a 50 basis point hike. Again, we've had somewhat of a roller coaster ride this year, so I think it's important to highlight that we've seen recessionary fears in early January as we had the slowdown in November and December. We then saw soft landing optimism emerge as the January data turned out to be stronger than expected. We then had too much of a heating in the economy and inflation picking up again, where we had the no landing worries, which would mean that the Fed would have to raise rates much further than they had telegraphed in their December kind of meeting. And then finally, we had a banking crisis fears, where Silicon Valley, Signature Bank, Credit Suisse, and the general system as a whole was questioned because there was clearly a liquidity situation for some of these banks, but also then this systemic problem of potentially assets and liabilities being mismatched due to the rising rate environment. Right now, we're more optimistic phase, as sort of seen by risk assets rallying for the last couple of weeks off of the pullback we had in mid-March, early March. And as a result, I think, we now have to take a step back and look at what sort of the bigger picture is telling us for this, if this rally is sustainable. And with ending this slide, I think on that note, we've seen Fed officials in the last week or so come out and say, well, we believe the financial instability has been contained. They have contained the contagion. And as a result, their focus is now again going back to price stability and tackling inflation, where they're continually saying there's more work to be done. And this again leads us to believe, me personally believe, that the Fed will raise rates at least one more time, if not possibly two more times, reaching that SEP projection they just released in March of around 5.25 terminal rate. Okay, so here we go again with inflation. Clearly, it is too high. That's well known by now. It doesn't add value to anyone, but I have to say it. When we look at some of the Fed's favorite measures or indexes of inflation, which is the trim mean and medians out of Dallas and Cleveland Feds, they're still showing a highly broad pulse that is mainly over 5%. So they can't take any comfort, even in the last week's recent PCE data or in the CPI for February, that inflation has resumed a downward trajectory after January's spike higher. What they can take comfort in some ways is that it's not going up much more, and it has seemed to stabilize. Now, that in itself isn't great given the absolute level it's at. But of course, after January, markets became very anxious about where February data would go, because they were concerned if it was a payback for some of the weakness we saw in the fourth quarter, or if it was really this new unleashing of sort of a new second inflationary pulse. Again, the Fed is making it very clear that they intend to not cut rates this year, and as a result, there is a clash between what market's pricing in and what the Fed is saying, and there's going to have to be a reconciliation there, probably now coming in the second quarter as we get further data. In the charts here, I highlight that the trim mean and the median are still at elevated levels, and funny enough, somewhat volatile when you look at the monthly changes. And then, of course, on the right there is the contributions of the core ex-shelter PCE inflation. And as you can see, that sort of stayed at an elevated level. And although there's been internal changes, it's still at a very high level now for multiple months with no relief there. Moving on, it is clear that things may be starting to slow. We've seen a little bit of that in the February data so far. The PCE data we got last week again showed that real spending had declined. This was a welcome relief given that it had risen significantly in January. Durable good and factory orders are starting to trend lower more consistently, although there's still some volatility in the data set on a month-to-month basis, clearly. And the importance of looking underneath, whereas transports have been a little bit more of a drag versus sort of core capital goods still remaining somewhat buoyant, is important to recognize as well. But overall, it looks like you're having a little bit of a manufacturing hard data slowdown, which would catch up to some of the PMI data from not only ISM, but also the regional feds that have indicated that new orders and activity, productivity have all been falling for the last several months. Finally, overall construction activity outside of residential has remained quite strong, not strong, but has remained stable. But single unit residential construction is dragging down the whole sort of construction landscape still. With that said, though, we've seen an uptick in sort of housing activity in the last month. This was due to a drop in mortgage rates and a readjustment to the new realities, a slight improvement in affordability. It's important to note that I don't know if that's going to be sustained, mainly because mortgage applications continue to trend lower, and there's clearly still a supply and demand imbalance in housing. But new uncertainty potentially from this recent banking turmoil, tighter credit conditions, it may all weigh a little bit on consumer sentiment towards purchases. However, housing has contracted so much at this point, a stabilization there, or even somewhat of a recovery, I don't think would deter the Fed from changing policy or be a big impact to policy, because quite frankly, it was sort of a leader in being more rate sensitive to the tightening of policy. And now if it recovers, there'll be other things that'll be moving inflation lower or moving growth lower. And as a result, it's probably a net positive to see some stabilization in housing. Here in the charts below, I identify consumer expenditures was negative. Like I said, capital goods, orders, non-defense ex-aircraft, which is the core capital goods you want to look at, is still positive, but trending lower, although it's somewhat of a volatile series as well. And finally, we're seeing kind of investment spending fall. We've noted that in some of the softer data in the PMIs and regional Fed surveys. You've seen the CapEx intentions come off, although in some ones they're still stable. And funny enough, looking over Richmond, and looking even in Dallas and New York, you've seen sort of a stabilization in expectations there, which is again a positive, because the whole point here is to orchestrate a soft landing for the Fed and not to crash the economy. And investment clearly plays an important part of that. It's a gauge on kind of business sentiment, staying positive on the future, but obviously then has a real GDP contribution and growth contribution. So watching that closely, seeing a little bit of divergence there in Q4. January and February, I've seen a little more of a stabilization in CapEx intentions. Again, the idea here is labor markets are key for the Fed, and this is really where they've tied their kind of bread and butter now to where policy would go. Core service ex-shelter is really being tied to wage inflation, which makes a lot of sense, but fortunately, it's still a little unclear what the lag kind of is between one and the other. You've seen indications that this is loosening. Now, we've seen that in sort of the softer data that I've spoken to before with the ISM and S&P PMIs. NFIB small business survey showed that, and the regional feds have shown that employment hiring intentions have all kind of fallen, and some of these surveys are actually contractual now, are contracting, excuse me. You've seen reduced temporary worker hiring. You've seen obviously increased layoffs. That's making a lot of headwinds. That's been mostly in tech. Obviously, everyone knows the story by now, and you've seen it in some other kind of higher overhired areas during the pandemic that have now adjusted to a more normal level. So that really at this point didn't show me that there is sort of this weight on labor and a real loosening. It just shows me, again, you're having a correction from overhiring during the pandemic period. But I think, unfortunately, for those who may have to, lose their jobs, or for those that are sort of in the crosshairs here, the Fed really does want to see kind of a below trend growth period to realign supply and demand to get inflation back to target. And that requires unemployment to rise, and that requires sort of more layoffs to occur in a broader sense. You've seen Fed officials talk to this a little, where they're seeing loosening, and the areas they're not seeing loosening are the ones that still have catch up to do. So, for example, I think Susan Collins spoke to this on Friday last week or Thursday, where she specifically noted that, she's not really surprised what she's seeing in labor. Instead, it makes sense that sort of frontline retailers that have, struggled to hire over the last year and are seeing an influx of business as the reopening now is completely finished and people have moved back into a more normal balance of online and in-person buying, that they are still hiring. So again, a lot of the labor market loosening, to me, it doesn't necessarily bode for a hard landing. It just seems to be a natural occurrence of supply and demand for labor moving back into a more natural level as the consumer has kind of moved back into a more historical normal pattern of consumption. But of course, and as we have to always note, the Fed is very focused on NFP job creation, which has been extremely strong. Even, I can't even really put it how like a 500,000 job hire in January was so many deviations above the expected economist projections. But it's really eye-opening. Now, there's obviously seasonality and there's some quirks in that data, but it's really hard for the Fed to say that they're having any progress when their job numbers like that are coming out. Obviously, we have a historically low unemployment rate as well, but there is some things to be said here. And you've seen some Fed research recently come out that have talked about over 2 million workers disappearing because of retirement, and that this is really a participation rate story more than this sort of historically low unemployment rate on its own would indicate. And finally, the jobs data, the JOLTS data has been a little bit mystifying as well. We saw it fall today, which was a positive. But the quality of that data too is questionable. There's 30% of respondents are responding, and this shows that there's a lower sample size. And when recently, I think a Wall Street Journal article went and started asking people, a lot of these openings are being left open without the intention of actually filling them, either because they're looking for that one star worker that's very hard to find, or because the other workers you already employ want you to hire more to show that you care, but you don't really intend to do that. Instead, you want to squeeze as much productivity out of your existing workforce without expanding it. So again, this is what I show on the bottom here. The ratio of job openings to unemployed did come down drastically today in some ways, but it still has a long way to go. I think that's important to note, but there is some progress there, and that was good. Although today's data, unfortunately, didn't show any sort of deceleration in quits, instead quits actually picked up slightly. Quits and turnover has really been what's driving average hourly earnings, and you really need to see that come down for the Fed to take comfort that we're not going to get this wage spiral kind of pressure that is the ultimate worry of central bankers and the ultimate destabilizer of kind of price stability. Finally, here on the middle chart, I saw the labor shortages are coming down as far as what respondents say. So these PMIs, these regional Fed surveys, they ask, are you having trouble finding skilled workers? And we're starting to see a more neutral reading there, whereas that was the story for the last year where they couldn't find, and as a result, compensation was having to go up to attract that. And also it made labor more sticky because you wouldn't be able to lay off people as easily because you wouldn't be able to replace them with the skilled workers. And this is obviously industry specific, but it certainly was a driving force of the tightness of labor in 2022. And again, the last chart just shows that as the quit rates and job openings rates are still at historically high levels, and they need to fall both in to come back to a more normal scenario, which would indicate not necessarily a loose market, but certainly a more normal supply and demand match between labor and the needs of it, hiring people. Okay, so consumers are becoming more worried. I think this is a big point. This is not yet really the driving thing, but this is sort of going to be the story I see going forward. And this is why I put a question mark there. Clearly, when bank failures are making front page news, and when we have sort of the already geopolitical backdrop and the sort of domestic political backdrop, there's a lot of sort of reasons for uncertainty for the average household in America. So far, the consumer's been very resilient because they stronger balance sheets during the pandemic, whether it was from all the stimulus coming in or was from the lack of spending due to the lockdowns. The balance sheets of most households improved. And there's obviously been a lot of talk about where saving rates are and how that's sustained the ability to keep up with rising inflationary costs. The purchasing power for income came down, but still we saw overall aggregate demand remain somewhat elevated versus expectations for the cost inflation would then impose on the consumer. Again, this is what I say now that, as wages are still rising and we have inflation at least stabilizing with headline inflation falling more aggressively, real disposable income is increasing. Now, the consumer basket is a made up basket. So if you want to actually just look more at things like gasoline and heating costs, those have clearly been some of the drivers recently that have driven headline down, while food has stayed a little bit more sticky. But that alone, with wages rising, opens up a lot of sort of purchasing power from the average consumer. And it also gives, end businesses the ability to pass on costs or even just to raise prices, because that's sort of the flavor. So one of the things I worry about is that, with sort of wages being more sticky and inflation now more stable, but some headline inflation coming off, you still have a better disposable income story that can allow for the core service inflation to remain longer. And that's probably what the Fed is actually trying to break. And that's why we need to see wages then come down. Let me just read the last point. However, recent financial instability and continued inflationary pressures are continuing to weigh on consumers. So again, we all have a different basket. We all have different inflationary experiences. But overall, you've seen consumer confidence pick back up recently as inflation's come down, primarily because of gasoline and some other areas that they're more sensitive to. But now, after the Silicon Valley episode and the recent sort of banking turmoil, the expectations would be that consumer now is probably a little rattled. And this is like a shock and awe experience for them, where now we're worried about recessions again. They're still feeling the inflationary pressures from, let's say, higher transportation costs, what you see in flights, or from food away from home and service sector more generally. But when coupled with the recent event, all of that increases the weight on their confidence. And I think the recent pickup we saw is starting to reverse. And you saw that on Friday in the University of Michigan survey with sentiment falling. You're also basically starting to see that more and higher frequency data. There's been, credit card data you can get on a weekly basis that have showed that discretionary spending has fallen in the last 3 weeks since the banking turmoil. So I'm watching that closely. The problem is, this was a recent event, and it takes a month or 2 months for the official data to pick up any kind of contraction in spending due to this greater uncertainty. But again, higher frequency data seems to indicate that there has been a little bit of a retrenching in consumption based on the recent events. And then just to go through the charts on the bottom, again, real disposable percentage income is rising. It's back to being positive. Household net wealth has fallen, but clearly is still in a highly elevated place. The cycle has not been fueled by credit. So I guess this is an important point to bring up as well, whereas prior great financial crisis was much more of a leveraged household balance sheet. As a result, it was much more interest rate sensitive. I think we all know that story about sort of teaser rates and mortgages resetting and everyone finding themselves missing out on a large chunk of their paycheck because it was going to their mortgage that had reset. That's not the case this time. And in anything, you've seen, a continuation of a stronger balance sheet, just from the credit component. Now, revolving credit has gotten back to trend and is up higher. And auto and student loan debts are still at elevated levels for sure. So I'm not saying by any means that it's an improving situation drastically, but the mortgage situation has stabilized now too. So as a result, you've seen sort of revolving and non-revolving trade places, and total credit overall has kind of moved at a less alarming level now, which is arguably more important. Clearly, if consumers are turning to their credit cards to continue purchasing power, that's an important thing to watch as well. And there's indications there that is happening. So, while delinquencies have shown some signs of rising across certain areas and credit card usage is up and the cost of that usage is definitely up, it's still at a point where it fits sort of a more linear growth level, and it has kind of just recovered from the entrenchment it had during the pandemic. I think now what we'll see is it'll start to move much higher and eventually will become, a problematic issue as household balance sheets deteriorate further. But, as we stand now, we're just more at a normal household balance sheet level versus the pandemic, which saw it strengthen, and prior periods before maybe recessions were had it at a very stretched and elevated level. Okay, so switching gears a little, money is leaving the system. We're all aware of deposit flight. A lot of money is moving into the money market funds. This is likely going to result in sort of a slower growth outlook and less inflationary pressures, simply from the fact that credit does drive, household and business decisions. So this is why Powell was recently, on the wire saying, at the March FOMC meeting during the presser and someone in the statements that he sees the recent financial instability as likely resulting in tightening credit conditions. And this is the same as sort of a rate hike. Now, it's still highly uncertain how much of this tightening will actually translate in the same way that a rate hike would. And I'm a little bit dubious now that things have stabilized in the financial system. You've seen sort of market drive credit raises go back up, meaning like, debt sales and even structured products have come to market in the last week after sort of freezing for that period where we had Silicon Valley and other banks under pressure. It basically, this is why I call it uncertainty, because the idea here, just to step back totally, is that the Fed will no longer have to raise rates as aggressively because market forces through tighter credit channels will do the work for them. And that is really an uncertain sort of concept, because it's one, going to occur on a great lag, whereas we're dealing with the inflationary pressures currently. And two, I'm more interested actually in sort of the shock and awe effects that businesses and consumers will get from the recent sort of headline driven, saga versus sort of the longer effects of a tighter credit system, which was, by the way, already tightening. And this is what I show in the chart in the bottom left. The SLOOS data, senior loan officer data, had already been for several months tightening. And, as a result, emergency borrowing often signals a tightening, which is what we just had a whole spat of, and still have an elevated emergency borrowing level through the Fed. But again, the system itself was continuing to grow the amount of loans and leases, and as a result showed a lack of sort of sensitivity to that. And I question sort of how quickly that can kind of come down and come undone to really put enough pressure on the economy to give the Fed confidence that inflation is trending to target. Now that's just in isolation. There's plenty of other things pushing and pulling on inflation. But if we are just focused on this one channel, I find it a little dubious to think that the recent financial instability was going to be worth anything more than one hike. And as the further we move away from this event and the more we see that financial stability has returned, the less sort of the Fed will focus on it, and they'll move back. And they've already started to do this the last couple of days and last week, move back to sort of this continued focus on, more work to be done. Let's get, actual core PCE back down to target. Again, so 2 more slides here. Where does this leave us? Uncertainty is high, as I've continually said. Recent financial instability and real growth is unclear, as I just said. And hence, the Fed policy decisions coming forth are going to be much more data dependent and much more two-sided in risk management. And I think, unfortunately, as we get a better sense of just what's going on in the credit space with either weekly or monthly data on lending and on sort of what we see in the public space of who's able to come to market, this higher for longer Fed kind of fear can reemerge, because we had somewhat of a slowdown in February, again in PCE. CPI remained a little more sticky. Clearly, January was quite an uptick. There's going to be a lot to drive inflation lower moving forward from the shelter component. I would expect goods, although maybe potentially to take a leg up with used cars, but to generally still have a deflationary tone, something that we saw Powell highlight as a positive. and something we've seen Brainerd, although she's left the Fed, but may share other committee members' views, say is a leading indicator. So core goods was, demonstrated to be a leader of core services. And when you couple in expectations for a looser labor market with falling wages, all of that should give the Fed confidence that we will have progress trending back to target by 2024. Now, how quickly this all occurs is obviously the real question, and why the January uptick through the whole kind of longer, higher for longer debate and, caused a little bit of the risk off bout we saw. Just to finish, the charts here show that the majority of the Treasury yield declines were in the real rates, which is what you'd want to see, and explains why we've had this better performance in growth, better performance in gold. We've seen sort of a more Bitcoin meme-ish kind of environment again. In general, obviously, there's a lot to say there in day-to-day specifics. The middle chart just shows that we have to remember that even if the Fed stops raising rates at 5% or 5.25%, QT, or the reduction in the balance sheet, will continue to put pressure, and the effective Fed funds will continue to creep higher, albeit at a slower rate. So, when you take the cumulative Fed, policy tightening actions, it's a much higher Fed funds effective rate. And that's something that's, I think markets are going to have to watch closely, because then the real question is if, this credit tightening and this kind of lower expected growth does come, do we end QT sooner than expected? And does the balance sheet now stay at a structurally larger place? And what does that mean for risk assets and for the money in the system? Which is something we can talk about, because in itself is a whole nother presentation. And the final chart, of course, is just the terminal rate, showing that throughout March, we hovered at 5%. This is below what the SEPs are telling us. And again, what Powell specifically said at the FOMC March meeting right before he left the stage was that is not what we are currently forecasting. So, there's a lot to say about rate cuts, but we're still not even at an agreement between markets and the Fed at what the terminal rate will be. Again, it's just an uninspiring backdrop for U.S. risk assets. We have high uncertainty, we have slowing growth, fundamentals are lackluster. The positive earnings revision momentum we saw coming out of January's better, economic data now faces heavier headwinds. The equity risk premium is still going to be persistently at its level and not really a great, enticer to bring in new capital. Multiples are going to probably be pressured now by real rates, the opposite of what's occurred in the last month, because as inflation trends lower and nominals stay sticky, you're going to have real rates rise again. So unless breadth improves, or unless you see another new catalyst, it's really not necessarily a rally I'm comfortable chasing. And by the way, when I say breadth, I mean this rally has really been driven by the top mega caps, and particularly one or two stocks in particular. And you've seen the video, you've seen Apple, you've seen Microsoft. These guys have put in a hell of a march, which has driven up the index because of their heavy market cap. But overall, you're not seeing a wide breadth, which is interesting in itself, because it allows you to look and be more of a kind of stock picker versus more passive and ride a kind of a cumulative wave higher, which I don't see occurring for some time. So just to finish, soft landing is still my modal case. Labor needs to loosen though, and lower turnover, especially something we didn't see today. This will reduce wage pressures. So when we come to Friday's NFP report, I'm going to be closely watching the average hourly earnings. I also want to see the work weeks falling, because that means capacity is still falling, and hence demand for labor should be trending lower. Shelter and goods should continue to pull headline and core down, even as super core moves sideways. And wage pressure, until wage pressure meaningfully subsides. Because remember, we've tied sort of the core service X shelter to wage pressures. And unfortunately, wage pressure should come down, but it just won't be coming down anytime quickly. Okay.
Okay. So I have a few questions. Do you think the contagion in regional banks in the US is over? Or do you think there's still some significant risk over there?
Yeah, I think there's some significant risk. I think we're in a sort of eye of the storm period. So 2 weeks ago on the midday macro, I tried to highlight where the balance sheets of regional banks were as far as their exposure to commercial property lending. This seems to be the next area where the market's really focused on, given what we know is happening to office spaces. We've seen the prices come down. We know this work from home thing has reduced demand. And as a result, they're likely to have potentially another hit to the asset side of their balance sheet here in the next quarters as that gets repriced to a more realistic level and you have some level of defaults. I think there's an expectation from sell side shops for a 25% default rate for commercial loans, which is for commercial loans that are coming due, I should say, excuse me, in the next year. Now, I got to check that, but that's a significantly high number, and it would indicate that we're not quite through this regional bank turmoil. It's just changing shape. It's gone from more of a liquidity issue, which Silicon Valley exemplified perfectly with the 2 days it took to have everyone pay, or even less than that, to take everyone's deposits out, which then put pressure on sort of the held to maturity side of their balance sheet being marked down lower and then becoming somewhat insolvent, although it's questionable and we still have to kind of see the details there.
Okay.
Yeah.
Okay. And do you have a personal take on OPEC and what is that going to mean for the Fed policy?
Yeah, so oil was expected to be in greater deficit already for the second half of 23. I think OPEC is sort of an alarming signaling sign in some ways, especially with the coordination with Russia. But they were already below their cited goal anyway due to capacity constraints. So the actual amount of physical barrels coming off the market is significantly less than the announced cut. Now, that doesn't mean that oil doesn't go higher. We recently went through a bout of inventory building. There's still some uncertainty over China's future demand. And as a result, it's not surprising that you've seen WTI, for example, go down to around 65, 66, and now it's bounced back up to 80 in a matter of maybe 10 trading sessions or less. I would believe right now we're sort of overbought and overextended, and it's back in this 6-month range after falling out of it due to, funny enough, the financial turmoil, the banking crisis kind of was a driver of risk off, and positioning exacerbated that move lower. So, I'll be more alarmed if we move above 85, because then I see kind of the speculatory side of the market pushing it even further. I still would be reluctant to think that we get to 100 or above 100 just from the fundamentals. Or, we could get there, but it would be more driven again on speculatory sort of action and pricing.
Okay. And the last question, you were talking about internal catalysts. What do you think about external catalysts from a US standpoint? What do you think of the risk coming from the outside, like Europe? Europe is facing a tougher time compared to the US, and given the fact that trade between the US and Europe is very important, what do you think of external factors as a whole?
Yeah, I think the general
and maybe you can talk about the main risks to look at.
Sure.
Yeah, okay.
Well, I think, stepping back for just looking at external risks, the main risk still to me remains sort of Russia, Ukraine, and the, chance that escalates. Again, many ways that could escalate, and simply disrupting commodity trade further alone would be probably detrimental to inflationary fighting central banks, because your headline inflation would be driving up your core through the process, how it works. Now, we were fortunate to have energy come down, natural gas especially. But as I said earlier, food is still very sticky in some ways. And as we know, inflation increases instability, and the general global economy operates under more pressure at inflation at these levels. So the sooner it can fall, the better it is for global growth. And Russia is playing a huge role in this last bout of inflation just from that resource channel. The second sort of larger geopolitical risk is the China-US relations. The rhetoric has not improved. It did take a lull a little bit over the winter, but it has picked up again and is indicative of a coming conflict. And China's emphasis on creating this dual circulation policy where they will insulate themselves from foreign inputs, whether it's raw resources or needed IT, indicates they still have wolf warrior mentality plans, meaning either Taiwan is going to be attacked in the next decade, probably in the later half of this decade, or they just are going to continue to sort of isolate themselves and divide the globe into sort of that side and the Western side, which, you know, is occurring. And we've seen that with the de-dollarization of trade in a lot of ways. But also just the alignment that sort of the Russia situation with Ukraine has caused in the pairing of partnerships. These are all big threats that can escalate into real wars, and as a result can change how you look at financial markets and what becomes valuable. Finally, speaking to Europe, I think Europe got a great break with this winter. There is indications inflationary pressures are coming off for headline, as you would expect with falling energy, but core remains stubbornly sticky, and the ECB has more work to do. You've seen a rebound in activity to some extent, and you've seen equities reflect that, but the question now is how much of how, you know, are we overly bullish now on the scenario, and where are the real modal outcome? So I'm a little dubious on sort of the risk asset performance in Europe based on this idea that they're going to continue to face sort of growth headwinds into the second half of this year, as will America, from not only tighter policy, but from persistent inflation, deteriorating kind of purchasing power. More so on the business side than perhaps the consumer side. But there is obviously a transmission mechanism through all of that, and there's, you know, lagged effects of that as well. So, you know, Europe this is something I'm debating on, where to get short European stocks and if that's an appropriate trade. Whereas the US, I'm more neutral currently at levels. I'm not going to chase this rally, but I see in the underneath there's still some bargains, and then there's still some expensive high flying mega caps.
Yeah.
And I guess, you know, just to think of any other risks, you know, again, trade generally is down. I think you knocked it there, because, you know, when you look at Korea, you look at Singapore, you look at different, you know, trade hubs and their data, it's all been falling, and that is a negative for global growth. And again, we need to, you know, it's been proven that globalization does unevenly raise all ships, but generally brings the global economy higher.
Okay. So thank you, Michael. I'm done with the questions. If you have anything else to add, feel free to do so. And if not, I really want to thank you for today, and thank you for your availability.
Yeah, no problem. I guess the main line is, you know, this is an uncertain time. You need to be tactical. You should be running a more balanced book. Don't be looking for that sort of beta to rise, and instead, you know, try and pair and match things where you're long and short if you're in the equity space. And as far as rates are concerned, I think, unfortunately, the pressure will be for yields to rise as we realize central bankers are confident that the financial turmoil has settled, and will then refocus on fighting inflation, which unfortunately continues to be sticky and give reason to have concern.
Okay. You will find Michael's newsletter in the description, so make sure to check that out. I'm done for today. I'm Giacomo. This is Hustle Hub. See you next time.
Thanks, Giacomo.